Hello, friends. Today we will be talking about the recently released monetary policy and its implications. In its first monetary policy of FY27, RBI has kept the repo rate intact at 5.5% while keeping the stance of the monetary policy neutral. It was expected to be so, but the most significant part of the monetary policy is the flagging of potential collateral risks from the ongoing West Asia crisis and its implications on the economy as well as on the banking sector, because it's very important to factor those as we go forward. The energy crisis is escalating, trade costs are surging, insurance costs are going up, and possible imposition of tolls on the trade ships that may pass through the Strait of Hormuz in Iran will strain all economies, even if passage is allowed. In addition to the West Asia crisis, the impending El Nino is another looming threat that could increase the climate risks and its domino impact on the farm sector. So we need to be watchful about that because of the adversities of the monsoon and cyclone and other factors. As far as the liquidity is concerned, the banking sector system's liquidity is quite comfortable with 2.3 lakh crores, and the weighted average call rate is within the range of corridor between SDF, that is a standing deposit facility, and the marginal standing facility, that is 5.25 and 5.75. That is the corridor as far as the liquidity pricing is concerned. That is the interbank liquidity. So that gives one comfort that the liquidity risk is there, but it is not very alarming. And the threats that are looming is if the crude prices shoots up beyond 110, 120, then the resultant impact on the inflation trajectory could be quite steep, as we have seen. Taking all these impending risk factors, real GDP growth for 26-27 is tapered down to 6.9% by RBI, and the base year of GDP computation have been changed to 2022-23 now. The real GDP for 25-26 now works out to 7.6%. So from say 7.6%, it is now expected to be 6.9% in 27 financial year because of the impact of West Asia crisis and its implications on the economy. The World Bank has already lowered its GDP outlook on India to 6.6%. Down from 7.2%, and Goldman Sachs moderated its to 5.9%, down from 6.5%, and the Nomura has already reduced its outlook to 7%. So on the whole, the unanimous opinion of the think tanks and even our RBI is that the GDP may get moderated, while on the other side, there is a fear of the inflation going up. Recently, the government has already extended the glide path of inflation tenure for another 5 years. That is, the inflation is to be monitored between 2% and 6%. That is 4% plus or minus 2%. So that is the glide path of inflation. That is our target. And RBI tries to cap it around 4%. That is the effort. And in January and February, the headline inflation was below the 4% target at 2.7% and 3.2%. That is, in February it was 3.2%. In January it was 2.7%. But now, in view of these risks which are coming from the geopolitical dimensions, the CPI inflation for 26-27 is expected to be in the average range of 4.6%. That means from 3.2 or 2.7 range, we are inching towards 4.7. That means the core inflation is set to be around 4.4%. So the inflation trajectory is having an upside risk. whereas the GDP growth is having a downside risk on account of the crisis that is going on now with no solutions around as of now, as we see. But RBI is very much committed to maintaining inflation near the lower edge of the glide path, that is close to 4%. That is the effort. Now, when we come to the flow of funds to the commercial sector, it is comfortable because the commercial sector is having a 4.4 lakh crores. That is the flow of resources to the commercial sector, up from 32.2 lakh crores. 40.4 lakh crores now compared to 32.2 lakh crores. That means there is an improvement in the flow of resources to the commercial sector. The main contributors to this is coming from non-food credit of the banking system and also from the non-banks. The credit growth of the bank is 13.8% in the fortnight of March 15, whereas the deposit growth has been lingering around 10.8%. So this growth of credit is higher than the last year, because the corresponding period last year the bank credit growth was 11% and now it is 13.8%. So there is some kind of an uptick as far as this rise is concerned. With these strengths, RBI's liquidity support, banks and non-banks will be able to ensure adequate flow of resources to the commercial sector to tide out this current crisis which we are which the globally all the sectors are facing. Another, as far as the regulatory dimensions are concerned, RBI has brought out certain ease of doing business measures, that is targeting the vulnerable MSME sectors, and enabled profit flows to strengthen banks' capital adequacy ratio and remove the investment fluctuation reserves. That is still in the proposal stage, but it is expected to be operational sometime in the second quarter of FY27. But the proposal has been moved to remove the investment fluctuation reserves because the capital adequacy ratio is comfortable, and Basel III has already imposed 2.5% of capital conservation buffer as part of the Basel III framework. So looking to all these things, a couple of points we should keep in mind as far as the banks are concerned. First is, there will be stress in the credit portfolio because the entrepreneurs will be facing some kind of a stress on account of supply side disruptions and rise in the cost of inputs. So there could be some kind of uptick as far as the asset quality challenges are concerned. And the borrowing costs, of course, have remained the same. So the credit cost may go up in the coming times. And we have to be watchful about the global implications and the risks that we will be coming up, we will be facing in the times to come because of the geopolitical crisis and the West Asia crisis, unless it is resolved in near term. So the monetary policy has been very supportive to help the industry tide over the current crisis, and also to ensure that the growth is not adversely impacted and the inflation remains within the trajectory that has been targeted. So we will be meeting more often, discussing on various other aspects as we go forward. Thank you so much.